Hey guys, welcome back to the Economic Analyst channel. So in this video, I'm going to give a little bit of an update to the gold forecasting model that I've put out. Back in July, I started making a prediction about a gold rally happening in late 2021. That really didn't manifest, and so now I'm coming out and being bullish about gold again. And I want to back up my thesis of why I am so bullish on gold instead of just telling you, oh, you need to buy gold and things. And I've given you some of my reasonings for it, but I'm going to elaborate further, quantify it, and show it to you in a group of charts so that way you get the full picture about what's going on in our markets and our economy and how that relates to precious metals and the gold price in particular. Now, in part one of this series, it's going to be focused on gold. Part two of this precious metal series will be focused on silver. So it's no secret that the gold price is finally beginning to grow again in its price ever since it pretty much topped off, I think, back in August of 2020. So the trend since the end of December has been an upswing for gold. And if we take a look at the channel that is established, my little, trend lines here, we can see that back in early February when gold dropped down to about $1,800 an ounce, based off of its trend for the past 2 months, it was oversold. And it looks like, with the recent gold rally, it's looking like, based off of its historical trend, it's a little overbought. So we might get a correction in gold, say down to about 1860 or 1850, and then it continues its move up if gold holds to its historical trend. Now, I'm not a religious cultic fanatic of technical analysis. There's a couple of reasons why that is. One is just basically past performance does not indicate with a degree of certainty future performance. Just because something has rallied 50% in the past doesn't mean it will continue to rally 50% in the future. You need to take a look at the fundamental forces at play that are driving those trends. And so one of the things that I think is driving this overshoot here has been the Ukrainian crisis developing in Russia. It's no secret that gold tends to rally during instabilities that develop in the economy, but also geopolitical forces. And unfortunately, when it comes to geopolitical tensions, it's hard to factor that into an economic model to forecast the gold price. So I know that a lot of people are jumping up and down and saying, woohoo, gold's going up, but you need to keep that in mind that in the wake of things, yeah, we're seeing this jump here, and it is definitely higher than where gold reached in the mid-November, but it's not nearly as high as where it was at May, and May had a lot more going to it. In May, what was going on is that we were seeing a rising interest rate environment. As investors were pricing that interest rates were oversold, inflation was rising, and so they were expecting the Fed to start raising interest rates and containing inflation. That didn't happen. The Fed stepped up, came in, and said, hey, this inflation nonsense is transitory. Don't worry about it. We're keeping interest rates low. So what happened to these investors? They sold all their gold, and they went right back into stocks, which I think was a very poor move. And so starting in July, I started calling and say, look, guys, we're going to see a gold rally out of this. Interest rates are going up. And when they continue to go up, it's going to kill the stock market, and the stock investors are going to flee back into gold. Well, that didn't happen. The interest rates surprisingly fell, and they continued to fall into about November. Why? Because the investors bought into the Fed narrative. But when it became clear to the Fed that this inflation stuff wasn't going to manifest the way that they thought, it wasn't going to just magically take care of itself, the Fed finally begrudgingly came out and said, okay, the inflation rate is not transitory. We're going to start engaging measures very soon to contain it. And then we see the bottoming out in gold. Now we're starting to see that uptick. So what's going to happen next? Well, let's take a look at some of the fundamentals at play. One is that the stock market growth rate is starting to drop. So when we take a look at the stock market year-over-year performance, which is in blue, compared to the gold year-over-year performance, which is in orange, Stock year-over-year performance is beginning to drop very heavily. So after stocks had this huge rally back in 2021 to March, where it peaked as much as 60% growth in a year after having a bottoming out in March, we are now beginning to see stocks take the hit and tank. And I don't expect the bottom to fall out in a historic stock crash like 1929 appears or 2008. But we're definitely seeing that retracement pulling down the stocks that are holding down the price as interest rates are starting to move up. Now, when you take notice here, it tends to be that when stocks underperform, gold overperforms. And when stocks overperform, then gold underperforms. Now, not always. Like if you take a look in the mid-'80s, they seem to go up kind of together. But more often than not, when one class of investments or asset is not performing, then the other one is overperforming and having historical returns. Why? Well, my thesis is that it's the interest rates. Low interest rates fuel speculation into overvalued, overinflated assets. In this case, it's been the stock market since the mid-'90s. And what's been taking the hit is that gold has been undervalued. Not valued properly. As an asset class, it has been overlooked because you can get all these huge historical returns in stocks. And why wouldn't you invest in stocks? You're investing in the economy. You're getting dividends off the stocks. They're much more liquid. The premium is lower. It's a win-win, right? And USA has been growing for the past 80 years. Why would you bet that the United States is going to fail economically? Isn't that dismal? Isn't that pessimistic? Where's the optimist? Where's the growth? Where's the future lookers? And that mentality has been what has been driving the investors into stocks over gold for 40 years. But the problem that has developed is that the driving force has not fundamental. It's been the interest rates that have been held artificially low by the Fed through printing money that has overvalued those stocks. And so gold has taken that hit, and now we're seeing that correction. Which brings me to my gold model. So the gold model that I've created can't really predict the gold price per se. What it can predict is the channel that gold will stay in between what I call the gold ceiling and the gold floor. The gold floor is in green, gold ceiling in red, gold price in gold, for irony's sake. And it does a pretty good job at predicting the peak of gold in 1980, and it does a pretty good job at predicting the peak of gold in 2011. Okay? What goes into this ceiling? Well, I've covered this before in previous videos, but it's basically three components. It is the money supply. So the more the money supply gets bigger, the better that is for gold. It's nominal GDP, so volume of goods being traded times price. The more essence numerically, the more goods that we are producing, even at a higher price, the worse that gets for the worse that weighs down on gold in relation to nominal stock prices. So, in other words, the more overvalued the stock market is compared to its historical norm, which it should run in line with GDP, the more that weighs down on the gold ceiling price. So, what we can see here is that back in the mid-'90s, this gold ceiling tanked, and it tanked because prices of stocks were becoming grossly overvalued, which depressed the gold price. But once the stock market started to crumble in the early 2000s, that started to rally for gold. And we saw this again after 2008. We see here how the ceiling is starting to build because stocks were crumbling and gold had a rally. So what's going on now? Well, based off of the unprecedented money that has been printed by the Fed for the last 2 years, the gold ceiling and the gold floor, which is the money supply, is just been escalating. It's been shooting through the roof. There is no reason to say that gold is going to fall If anything, gold is going to climb, and it's going to climb very sharply. The only question is when. Well, what's holding it back? It's that investor mentality. The investors are not just waking up all of a sudden now and saying, gold is the play, guys. Let's all move into gold. What's going on? Well, they're uncertain right now. That's not a bad thing. That means they're beginning to question, and they're saying, hey, you know what? Maybe this stock market rally is not so sustainable. And there are some that are beginning to feed into gold, but this is a cautious move because outside of the 2000s, for 40 years, gold, if you bought gold, you lost. You lost. Let's say you bought gold in 1980 when the interest rates were at 20% and the inflation rate was at 15%. You bought it at 704. For 20 years, you would have lost nearly 2/3 of your wealth. Who wants that as an asset class? But if you manage to look and say, you know what? I'm not a rocket surgeon here, but I think gold's really low right now in the 1990s. And the chart here bears it out that it's at the floor price. You bought gold here at $250 an ounce, and then you held it till the peak here using this gold model. Why, you would have made 7 times your money in 10 years. So holding gold for the long run tends to pay out, but the question is, where are the peaks and where are the floors? That's what this model tries to calculate here. And so far, what it's saying and suggesting is that we are close to the floor. When we look at it on a relative scale, so we're looking at this logarithmically here, gold is closer to its floor than its ceiling than it was back in 1999 and 2000s. This is strongly suggesting that at some point in the near future, gold is going to see a rally, okay? Now, where's that? How high can that rally be? Well, based off the current stock price, gold could go up to about $3,000 an ounce. Actually, it's going to go higher as the money supply continues to increase over time, as well as the stock price continues to fall. So, I'm going to lay out a couple of scenarios for you about how I think gold can perform in the coming years, okay? Now, scenario number 1 is that gold kind of performs the way it did during the 2000s. Okay? And this is more my bearish scenario, really. Okay? This is the forecast here. Now, gold here, we're looking at the floor, we're looking at the ceiling, we're looking at the gold and gold price. Here, I am assuming that investors are begrudgingly buying gold, but they're not just rallying up to the ceiling here. They're buying it, and it's beginning to lift off the floor over the next few years. The interest rates are slowly going up, okay? So this is assuming that interest rates are only going up to about, say, on the 30-year Treasury rate, about 0.2% per quarter. The ceiling is lifting very high, and you may be wondering why. And it has to do with this huge money supply growth rate and the fact that the stock market is holding relatively stable. There's a little bit of growth in 2024 compared to GDP. Now, what's looking at the gold floor and gold price? Well, trading between 2,100 and a whopping 7,800 because of all this money that is printed and spent in the economy, assuming the past trend. Now, obviously, the Fed's going to change monetary inflation, and there's really no way to calculate that. So don't pay really much attention to how this gold forecast is looking like 2 or 3 years out. There's really no way to look at it. My bottom line to tell you is that when we can probably reliably forecast this out a year, and the year-end price, assuming that we approach the 2000s like, is a 15% rally and will reach close to 2,100 for gold. Now, why do I say a 15% rally? Because that tends to be the performance on gold during the 2000s. Okay? So gold during the 2000s tended to perform, on average, say about 15% per year. And I think that's really the low end here because we're not really catching up to the ceiling, and I only see that gold ceiling rising unless if we see a quick turnaround in the stock market. But I don't really think that's going to happen because interest rates are going to build. So gold has been undervalued. The story here is that gold has been undervalued for quite a while. And now with the pumping of the money supply increasing at exponential rates, it's only going to force up that gold price. Scenario number 2 is pessimistic for the economy, obviously, more pessimistic than scenario 1, but very much more bullish to gold. And scenario number 2 is where we start seeing returns like the 1970s, okay? In this return, we see that gold still holds closer to its floor, but it starts to lift more over time. 1 year out, it looks like gold will hit about $2,400 an ounce, or about 35% year-over-year returns. Why is that akin to the 1970s? Because when you take a look at the average gold performance in the 1970s, it tends to be about 35%. That tends to be the growth rate for gold during the 70s. So bottom line, I'm looking at gold performing, it's got to perform in 2022 at least 15%, probably going to be 35% in the wake of rising interest rates, okay? Now, gold so far in the 2020s is actually not doing bad. It's actually performing at 10% per year. What happened is that gold rallied by 25% in 2020, but then it languished and did absolutely nothing in 2021. So when we take a look at the gold rally from 2020, if you bought in the beginning of 2020 for gold, you would have made 25% of your money. That's a huge return. But the problem is that it didn't continue in 2021. Gold languished, and then the average growth rate is really about 10 to 11% on an exponential basis, but the average year over year is about 12 to 13%. So what am I expecting? Well, I'm expecting a little bit of a higher performance on scenario 1 than that, saying, I think gold's going to rally 15% by the end of the year, especially as with each passing inflation rate report that comes out, both on the CPI and the PPI, investors are waking up and realizing that, hey, this inflation rates are getting worse, or they're not getting better at the very least, okay? So by no means am I telling you we're going to see this huge, gigantic rally where gold is going to reach its ceiling of $3,000 an ounce, or even go up to $7,800, or in the 1970s over $10,000 an ounce. What is that telling you? That's telling you what that future gold price could be if we really start seeing the rally take off. In other words, the sky's the limit. Remember, if you bought gold during the 1970s, you would have made 25 times your money. If you bought gold in the beginning of 2000, you would have made 7 times your money. Well, gold right now is at $1,800 an ounce. Then it makes sense that over time, the real ceiling for gold, aka the maximum price for gold, is multiple times the price for gold, because gold has been undervalued now, just like it has been then during the 2000s and in the 1970s, as the stock market underperformed and the money supply was increasing, and we were having high inflation rates, and the interest rates were pushing upward, valuing those stocks down and pushing people into undervalued assets like gold. That's the narrative that I've got right now, and I think it's a pretty good one. When we take a look at the gold ceiling to floor ratio, okay, so how gold is performing in between. Typically speaking, gold tends to perform, as we expect, right in the middle. It should be performing at about 50%. And as a matter of fact, I'm going to put in the trend line so that way we can get a roll of this. Yeah, it tends to perform at about 50% of the gold ceiling to floor ratio. Where's that ceiling to floor ratio right now? Popping down at 9%. It's pathetically low, and it's because the money supply has been increased, but we did not see the corresponding increase in that gold price. At some point, that's going to trigger into the investors. The investors will flock into gold, and we will see a strong rally in gold approaching its 50% gold to ceiling ratio, or even overshooting if investors start panicking. So that means gold could have years in the future where it rallies about 50-60% in a year. I just can't predict when that's going to be. I can't even say that's going to be in the next 2 to 3 years, so I'm not even going to bother with you. Instead, I'm going to give you the safe, conservative estimate, which is still strong returns on gold, I believe, of $2,100 to $2,400 an ounce by the end of this year, and then we'll see how things play out. Now, if I were to guess, if I were to guess which scenario is going to play out, I would be even err on the side of caution and say $2,100 an ounce. Why? Because again, that investor mindset is hesitant and resistant to buy gold. It's not, everybody's not looking and saying gold's the play here. People are saying, oh, okay, gosh, stocks are terrible, bonds are terrible, my crypto investments are falling. I guess I'll buy gold. I need to hold some gold. I've got to hold some safe assets. But it's not like there's this excitement and there is this rush to buy the precious metal. Now, there is a demand for it. No doubt there, and that demand is building. But until we start seeing that crescendo, that rush, that tsunami flow in, I can't really say when that's going to be. That's psychological more than economical. Then I can't really put this in my prediction. All I can say is that the elements, the ingredients for a strong gold rally is there. It's definitely there. It's just a matter of waiting to play out. Like, think about it during the 2000s. If you bought it $250 an ounce, yeah, you would have made a killing, but you still would have had to wait 2 or 3 years before gold really started to ascend and start going through its sharp increases, okay? So just be patient for that. But if I were to guess when we're going to see that powerful gold rally manifest, I would say it's probably going to be around 2024, 2025. There's some reasons for that, but namely speaking, I expect an asset bubble to burst in the stock market, the credit bubble to burst, and we go into a recession then. And I think that's when people are really, really going to panic and buy the precious metal, particularly if the Fed tries to bail out the banks massively through massive quantitative easing programs. So guys, stay tuned for that. And now part 2, I'm going to cover silver, which flows with gold. It definitely runs with gold, no doubt there. But silver's kind of got some interesting diametrics to it, so to say. And I'll go into that in part 2, which I hopefully will release tomorrow. Guys, thank you for watching this video. If you have any questions or comments, please let me know on this. Let me know what you think. Am I crazy as a bedbug here? If I'm off the walkers, let me know. If I'm right, or if you think I'm right, or if you think I'm even undervaluing gold, let me know on that. I mean, I'm not perfect here, and everybody's got their own biasness. Let me know what you think about the data that I've been giving to you. Is my data on or off? Am I considering something, or do I need to consider another thing that I have not put into my model? Guys, once again, I thank you for watching. If you like the video, if you like the content that I provide, make sure you click that like button. Make sure you subscribe to my channel if you haven't already. And that way, if you click that notification bell, you'll always be notified when I upload a video and provide you fresh, new content that's different from what you'll get on other channels. At least I think it will. And it'll provide some value for your life and give you some sense of what's going on in our markets, our economy, and what's going on in the investment classes. Once again, guys, I thank you for watching this video. I'll try to post part 2 tomorrow on silver. And until then, I'll talk to you next time.